We are half an hour away from the opening bell in Hong Kong. You're watching the China Show. I'm David Ingles. Let's get to your top stories today. Asian stocks steady. That's as traders await, of course, that crucial Fed decision on interest rates. The dollar is holding around its lowest level since January. Now, Hong Kong's largest listing this year, in fact, in 3 years, Midea is set to trade after raising, $4 billion, giving a mood check on investor confidence here in the city. Plus, we'll hear from the former European Trade Commissioner, Lord Peter Mandelson, on what firms should be doing if they get caught in this crosshairs between tensions between the U.S. and China. Right, welcome to the show. Hope you're all well. We're going into the Tuesday session right now, and as you can see, a little bit of pressure coming through as far as price is concerned. It goes without saying, of course, there's a lot of event risk on the table, including where we are as far as the Fed conversation goes. Mainland markets remain shut today. Just keep that in mind. So we'll get an indication, of course, of perhaps what mood music is like when we get the open in Hong Kong. Plus, of course, that big listing here in the city. A reminder of some of the markets that are shut today. As you can see, bottom of your screens, there's still a whole list of them out there. Volumes should be still on the lighter side of things. The big question is, of course, has this dollar decline got a little bit too far? Is it time to fade 50, or is it time to lean into 50? More on that in a moment. China proxies overnight. This is how they traded. Of course, you have everything from the Golden Dragon Index, some of the ETFs there as well, and also the X trackers, which track specifically the CSI 300, actually closing higher overnight. So we'll see what happens as we go into the session today, where, by the way, in case you missed it, we're up 3 days on the Hang Seng Index. We're up 5 days on the Hang Seng Tech Index. So that maybe just should be something to consider. And some of the tailwinds going into the session today. Dollar China, and also where you are with the yuan and the yen. Of course, with the yen taking out 140 yesterday. And, of course, for this specific pair, I think we flipped it around. It should be yuan. In any case, of course, we're trading at, well, in this case, the highest since this year, the lowest on China, Japan, as far as the exchange rate is concerned. Right, going into today, we mentioned this as well. So in the gray markets, 6% higher on Midea. We should be getting an initial indication of how that should be trading in a couple of minutes or so. Apart from that, everything from really along the Fed conversation, HIBOR has been falling. So I think at that level, we're now at the lowest going back to, I think, May of 2023. As far as HIBOR is concerned, mainland China is still closed. And, of course, we're still tallying up the damage following the typhoon, which swept through past tense Shanghai and neighboring cities and provinces there. Right, we're looking at the open today. Let's have a look at where we are, please. I think the big IPO, of course, is Midea. I think we have live pictures. Do we have that as well? Of course, I guess in many ways, it's a company story, what they're going to do with the money, this international expansion plans, goes into that underlying theme of Chinese companies going abroad. That's number one. Number two, what is the mood music like for IPOs and listings here in the city? And certainly, $4 billion goes a long way in jacking up the ranking of Hong Kong as far as equity money raised. So we'll see how this looks, of course, in a couple of minutes. But yeah, let's bring in Stephen Engle, of course, our Chief North Asia Correspondent, our co-pilot these next 2 hours or so. You've been covering this company as well for a long time.
Yeah, I think this is a shot in the arm, obviously, to Hong Kong and Bonnie Chan over there since taking over earlier this year. And she's always kind of kept the big names in her back pocket. And she says, I know you're going to ask me, Steve, about the pipeline. Well, this is a big pipeline. It's a recognizable name, and investors are latching onto that rather than the high flyers, potentially high flyers of tech companies and the like. This is a washing machine, air conditioner, elevator maker, the biggest appliance maker in China. It's a well-known name. Is it going to have that big pop? We don't know, but it's, as you said, indicating higher. It seems like it ages ago since the previous largest IPO in Hong Kong, 2021, and that was Kuaishou, $6.2 billion. Yeah. This is $4 billion. And that's a good boost. It's now pushed Hong Kong up past all of last year at 6.5 IPO proceeds.
Yeah, just with one transaction. It was already upsized and will I guess we'll find out whether or not they do exercise that over-allotment. There you go. That's Bonnie Chan, of course. There we go.
There she is.
In our live shot right now, 25 minutes to the opening bell. Right. We'll set that aside for now. We'll have a look at the macro picture right now. Of course, it's still all about the Fed and what they do and how they do it. We heard from the former New York Fed President, Bill Dudley. He's actually backing 50 basis points as far as that cut is concerned. Have a listen.
The market has come to the view that 50 basis points at this meeting is, in fact, appropriate. It's pretty important that the Fed head back to neutral expeditiously, and that 25 basis points wasn't fast enough.
Right. The current pricing right now as far as swaps go is, let's just call this a coin toss, really. 54.45, and this obviously changes minute to minute here. Ahead of that crucial Fed decision, let's bring in our team, Garfield Reynolds, who leads, of course, our MLive coverage, and also to talk about the currency angle, our chief Asia FX and rate strategist, Stephen Chu. Garfield, let me start with you. What should the Fed do and what will it do is the question.
Well, it's one of those interesting things. Our chief economist, Anna Wong, in the US is pointing out, if you look at the data, 25 basis points would seem to make the most sense. That's also my sense of it. I was skeptical about the need for more than 25 basis points, even before we got a reminder that inflation remains sticky. However, the question is, what will it do? And, there had been a general sense that Fed officials, especially Powell and some of the kind of inner circle, were far more concerned now about the growth angle, about the employment angle. If you are concerned about the idea that the jobs market is on the verge of cracking, then 50 basis points would have a compelling logic, because you would be looking at a situation where sooner or later you're going to need to go in a direction that is consistent with going at 50 basis points at one of the next few meetings. And if you're thinking you're going to go 50 basis points at one of the next few meetings, well then yes, of course, you should go 50 straight away. The bigger difficulty of the Fed now is with markets so tightly balanced between 25 and 50, it runs the risk of setting off turmoil no matter which way it goes. If it goes 50 basis points, it runs the risk of spooking markets because it's signaling it's closer to a recession than many might have hoped. If it only goes 25 basis points by now, you'll get a jump in yields. You'll probably get a bit of a sell-off in equities. You'll get concerns that the Fed is behind the curve and that whether or not we're in a recession now, it's not going to act expeditiously enough to avoid one.
Let's bring in Stephen Chu, Bloomberg Intelligence. Would you agree with what Garfield just said, whether 50 or 25 is going to spook the markets either way? And also, isn't it more important now, because we're going to get either 25 or 50, that's baked in, right? There's going to be a cut. But we need to see the path and the degree of these rate cuts over the next year.
Yeah, I totally agree. If you look at the U.S., especially the job market, it's still very resilient. Over the last 12 months, job ads have still been near like 200,000. That's still very strong. Of course, it's far lower than the peak that we saw after post-COVID, but still, it's still very strong. So I think actually 25 will be a prudent move. But of course, market is so baked in for 50. So that's why it depends on whether the Fed want to give what markets want. So that's the bottom line. At least 50, the market will be happy to continue to sell the dollar from here.
Right. Drop. And don't give me 50. We'll see. All right. Stephen Chu, thank you so much. Our team there. And, of course, Garfield Reynolds in Sydney for us, who leads our MLive team in the Asia-Pacific there. Right. We're also looking at this other big story in tech, Intel suppliers. In the region, very much in focus here. That's after the chip maker announced this new partnership with Amazon's AWS. Let's bring in our tech reporter, Annabelle Jewellers, of course, to talk us through the details of this new deal, Belle.
Yeah, so essentially, we know that Intel's had this big turnaround plan. I don't know if you recall the results a couple of weeks back, but they were very, very bad for the company, and they just sort of indicated yet another quarter of lackluster growth. The company was pushing through with these job cuts. We've seen the stock slumping around 60% this year, and so it really needs a big win. And this is one of those, because they've just been able to manage to get AWS, Amazon's cloud business, as a customer for the foundry business. Now, AWS is the biggest spender on data center chips. This is significant. The chip they're going to be manufacturing is a so-called fabric chip. We don't know a lot of details around this. You could call it sort of a networking chip, but the main thing is it's not sort of the kind of chip, the mainstream chip that they'd hoped to make billions and billions of dollars on in the years to come. It is, though, a start for the business and for Pat Gelsinger, who's really been trying to turn around the business.
You mentioned the foundry business. What changes are in store there?
So essentially, they're really trying to build up the foundry business. We know that's been one of the key pillars of this turnaround strategy. As part of that process, Intel needs to be able to tell customers, prospective customers, particularly the likes of AMD or NVIDIA, if you give us your chip designs, your most precious IP, we will keep that separate from our own chip design business. And so they're really fully separating the subsidiary now, making it fully independent. That's a big step forward for the business. The other thing as well is just in terms of how much market share they're continuing to gain or the kinds of customers they can attract. Something that helped their stock price intraday was this news around the military, because they've just said that they're eligible for $3 billion in US government funding to manufacture chips for the military as well. So another win for the foundry business.
So as they pursue this, are there projects that they're putting on ice? Where are they scaling back, for example? What are the trade-offs here? There
are, of course, trade-offs, exactly. It really relates to the international expansion plans. And we actually had an interview with the CEO, Pat Gelsinger, a little while back. Ian King did this one from our Bloomberg News team. But the main thing is that they are sort of having to think, okay, what are our goals and what's the reality of where we're at right now? And so they are scaling back, particularly in Germany, in Poland. Those projects, their construction projects, are going to be paused for at least 2 years, depending on market demand. There's one in Malaysia, for instance. It's been a very big market in Malaysia for chip assembly and packaging.
That's right.
They're going to complete that project, but they're perhaps not going to make it fully operational until there's demand. But again, it is that push to build up the foundry business, to make it profitable once again, to execute that turnaround strategy. And it does seem to be focusing on its U.S. operations for now.
Bill, thank you so much. Annabelle Jewellers there, our tech reporter. Right, going into the Open today, 19 minutes away, there is one of the very few stories in town. Here in Hong Kong is this listing here, the biggest one in 3 years, and we are indicated very sharply higher on Midea Group. 54.80 was the listing price. I'm now looking bid-ask at around $60, and it indicates what? 10%? Well, we'll see in 8 minutes what the pre-market looks like. Live pictures, of course, of the Hong Kong Exchange and this listing ceremony. Counting down to the open of trade, you're watching The China Show. Right, welcome back. You're watching the China Show. Just some breaking news very quickly. So over in Malaysia, one stock in particular is going through the roof right now. We were up as much as 32% in the opening minutes. We pared back. As you can see, this is Top Glove. It's a maker of rubber gloves, of course. This is on the back of these higher tariffs between the U.S. and China. And of course, the iteration there is the U.S. is imposing higher tariffs on gloves made in China to rise to 50% in 2025 and 100% in 2026. That's according to Citigroup, citing, of course, the USTR. And that's up from the proposal back in May of just 25%. So the alternatives, as you can see, are going through 20% in this particular case, Steve.
Keep an eye on this one, obviously. Yeah. Well, Zhang Zhiwei is the president and chief economist at Pinpoint Asset Management, and he joins us now. Zhang, good to see you. So we had all that data yesterday, worse than expected. All the metrics were below analysts' expectations for August. Are you surprised the government and authorities and policymakers haven't come out with what the market probably wants, and that is a bazooka-sized stimulus package?
Yeah, well, we've been waiting for that in the market for quite some time by now. I think, kind of people gave up on that idea already. I think that nowadays the big question is what the government will do going into the end of the year after the U.S. election, whether the government will, react to the economy in a more, in a stronger way. But I don't think the bazooka is coming anytime soon.
So we're almost running out of time in 2024.
Right.
What does 2025 look like? Do we start looking ahead now to next year then? What the economic targets probably should be?
It's a big question mark, right? So I think to a large extent it also depends on the outcome of the U.S. election. But the thing is, nowadays, I think in the market, investors, we don't really have a very clear view on the government's reaction function anymore. I mean, right now, the way the government set policies on fiscal, monetary, all these policy reaction functions, I think are so different compared to, say, even 2 years ago. So, whether maybe is 4.5% a growth target the government tolerates, or even lower, or is it okay to have a sort of a GDP deflator in the negative territory longer? This we're not sure. So we have to wait, I think, until December to find out the growth target in the Central Economic Working Conference.
Is it wishful thinking to hope that the National Day long Golden Week holiday that's coming up is going to spur some spending and some travel and some home buying?
Yeah, I mean, actually, if you look at the holiday data, right, so consumption data, high-frequency data, they are okay in the past holidays, particularly in terms of the number of people traveling. But if you like the consumption, so per traveler consumption data is not very strong, right? So people still travel, but they spend less, or they go to more affordable places. That seems to be a new trend.
You mentioned the reaction function. It's not what we're used to seeing. China used to see there's a pocket of weakness in the economy, and we're used to seeing this respond and respond forcefully.
Right.
Might it actually be a good thing that they're perhaps focused on some of the more structural, fundamental issues in this economy, including, of course, leverage, which was a big issue many, many years back. Still is.
That's right. I think there's a trade-off, right? So in the past, you could argue that the government probably reacted a little bit too quickly, right? So and built up the leverage too fast. But at this juncture, with deflationary pressure so strong, CPI, PPI, GDP deflator all going in the same direction, I think the risk is actually way too long, and it become very costly if you want to get the economy out of the deflationary environment.
Well, we saw over the weekend, including yesterday, a number of Wall Street banks all downgrading expectations for growth to about 4.6 or 4.5 from Goldman and Morgan Stanley and Citi, and next year 4.2 to 4.5. I think it was Goldman that was talked about that deflation debt loop. We were up there at the Bund Summit a couple of weeks ago. Gong, the former PBOC governor, talked quite extensively about the deflation issues. It needs to be more of a priority. Were you surprised that also on Friday, after we got some of those credit numbers, the PBOC put out a statement saying this is going to be our priority for the rest of this year, is combating this deflation?
I think it's I would put it as a healthy step to acknowledge the problem. In the first half of the year, one thing I was pretty worried about is that people don't talk about it. I mean, CPI number, PPI number, clearly there's deflationary pressure, but there's no discussion, open discussion in the public about... I
don't think they were really encouraged to openly discuss it. That's why when Gong talked about it, it was interesting.
That's right, exactly. I mean, I saw the news. I think that was a positive step, right? At least we acknowledge there is this risk that we need to deal with it. And then probably there will be discussion on what kind of tools that you need to utilize. Is it monetary or fiscal? We can talk about other, experience, say, from Japan, from other countries, how they dealt with it. Maybe that will lead to more sort of a meaningful discussion in December in the Central Economic Working Conference.
And the talk of it being more fiscal, likely. My question now is, are there bottlenecks that are simply preventing them from delivering more fiscal stimulus, or is it more a capacity issue that there just isn't a lot of land sales? There's not a lot of tax collection. What is preventing this fiscal bazooka from coming to fruition?
Yeah, so I think it's the way that people think about the macroeconomic challenge that people China face these days. Whether we need to run a much bigger fiscal deficit on the central government level, that's a big question. That's the way that people think about the problem would need to change in a big way. I mean, the land sales is not going to come back anytime soon. I think that constraint is always there. The question is whether somebody need to leverage up in order to pull this economy out of the current condition. Central government is in the position. I think that's the kind of consensus among economists. Hopefully that idea get more traction in the policy circle.
Zhang, what's your hot take on the changes that we got, essentially raising the retirement age? Is now the right time to do that? Online chatters, they're not happy about this.
I know. I mean, I think it's a matter of time. This will happen. I thought it would have happened earlier, but I guess the COVID kind of delayed it until today. Timing-wise, I'm not sure this is the best timing, given that there's a lot of the labor market is quite weak, right? So, and this is graduation season that a lot of young graduates looking for jobs. But you could argue there's never a good time to roll out this kind of reform, that there are always people complain. But I think it should be coupled with other policies that hopefully can address the labor market condition, like a fiscal action, right? So that would be probably more helpful.
Zhang Zhiwei, as always, a pleasure to see you, and thanks for making the time. Fantastic insights, as always. Zhang Zhiwei there, President and Chief Economist at Pinpoint Asset Management. Right, the biggest listing in Hong Kong in 3 years is up 8% in your pre-markets, massively oversubscribed, upsized offering. Do we get an over-allotment option? 8% higher in the pre-market. The open, 7 minutes away. You're watching The China Show. Welcome back. You're watching The China Show. So we just had the Hong Kong Open today. Mainland China, Taiwan, South Korea, and other markets are still shut today in the region on a holiday. Going into the Open today, we're looking at a Hang Seng Index. And just keep in mind, we did get some tailwinds out of Wall Street overnight, although there is, of course, that event risk book ending maybe the next 36 hours or so with that Fed decision coming through. We're looking at declines, as you can see. We are coming off the successive days of gains on the Hang Seng. 5 days going into this morning, 5 days of gains on the HS Tech Index. Very quickly, speaking of the holiday, some of these tourism-related stocks on your screen, so everything from casinos. We'll talk about airlines, railway, and some of these other, like Fosun tourism. This is there's a separate story, of course. We can talk about Fosun later on. 3.5%, but one stock is very much in focus today, Stephen.
Absolutely, and that's the biggest appliance maker in China, known for making its air conditionings, washing machines, elevators even. That's Midea in the pre-market right now, up about 8%. Basically, Midea priced this stock at the high end. It was 54.80 Hong Kong, now 59.20, indicating ahead of the open. Order books were multiple times subscribed, and Midea exercised a plan to boost the size of the offering by some 15%. So we'll have to see the opening bell coming very soon. We'll be right back. This is Bloomberg.
Welcome back. 40 seconds to the opening bell. And, of course, the big listing here in Hong Kong today. Are you ready to dance to the beat of the gong when Midea comes online in 30 seconds' time here? We're called 8% higher already. 12 million shares traded in your pre-market. This was already priced at the top end of the range. It was already upsized. Do we get an over-allotment? So all things do point to a flyer at the open. The question is, what does this signal about the health and investor appetite for new listings and capital raising in Hong Kong, the bigger picture? And what does this mean, of course, moving forward for other Chinese companies looking to pull the trigger in this opening rally? Let's listen in.
祝贺美的集团在香港交易所成功上市。Congratulations on the listing of Midea Group of HKEX.
All right, gongxi, gongxi. We're looking at the open today. And by the way, mainland markets are still shut. So to those joining us, of course, from your living rooms, half asleep in bed, maybe from the pub, maybe at the beach, thank you for joining us. Happy Mid-Autumn Festival to all of you. We're looking at the opening bell in Hong Kong here, down up about 0.1%. HS Tech is pulling back after what's been 4 or 5 days of gains. At bottom is not a lot of movement as far as that is concerned. Of course, we're looking at property specifically as we move into a Fed that is likely going to cut rates. Well, let's hope they do cut interest rates, for one. The question is, do they go 25 or 50? If they go 25, do they signal more? If they go 50, do they, I guess, give it a more guarded tone across these markets? Dollar China right now trading at about 7.10. The other exchange we're looking at here is the yuan against the Japanese yen, and that pair, of course, given the surge in the Japanese currency, is now traded also at the lowest of the year. We're looking at shares of Midea. Can we get that up, please, if we can? So just keep in mind, once you see the price, 54.80 was the listing price, and we're now just short of $60, which effectively would mean we're also short of about a 10% gain going into the open today. As you can see on the left side of your screens, company executives and, of course, the chief executive of the Hong Kong Exchange, Bonnie Chan, there we go. Exchanging what appear to be, well wishes. Let's see what happens, of course, with the stock, Steve.
Yeah, get it on. Bang a gong. Was that T-Rex, right?
Yeah.
T-Rex. All right,
Yeah.
I'm dating myself. All right, our Asian stocks reporter, Sang-Mi Cha, joins us now. Sang-Mi, so we're watching the festivities down at the HKEX. Tell us how important, obviously, it is this for Hong Kong. A $4 billion IPO. It looks like it's multiple times oversubscribed. It's something Bonnie Chan's been waiting for quite some time when she's always talked about the pipeline.
You're absolutely right. $4 billion raised for the first time. It's the largest deal for the first time since 2021. Back then, it was Quasho Technology, which raised about $6.2 billion. But that back then, the situation was a little different. It was a lot better. So at one point, Hong Kong was a bright spot for IPOs, and this would be a test for the city. A lot of the companies are watching the success of Midea if the listing turns out very well, and we are seeing the successes in early morning. But this would be a boon for the companies that are watching Hong Kong to perhaps come back, and there will be more of that sentiment coming back in the IPO market in Hong Kong. And also, this would be good for Hong Kong that's been trying to boost liquidity as well, overall for its stock market as well. So that overall, it's a win-win situation for all the companies and the investors and Hong Kong as well.
Yeah, and we'll see whether this does open up the floodgates for the realization of the pipeline. Sang-Mi, the other thing that might be helping at least the macro environment is interest rates coming down, right? We know we import that from the U.S. because of the peg. And I think you have a piece out today on how this might help this beleaguered property sector in Hong Kong. Just take us through the thinking here.
That's correct. So the Hong Kong interest rate is tied to the U.S. because of its currency peg. And so Morgan Stanley analysts predict about 8% home price recovery in 2025 for Hong Kong properties. That's reversing a potentially 8%, so 5% recovery, and that's reversing that 8% drop in the property home prices this year. So that would be a boon for the property companies that's trading at all-time low valuations, and that's going to benefit a lot of the developers like Sun and Kai or Henderson Land that have these inventories. And that's because when the investment sentiment is turned, then there will be more volumes, and ultimately that will lead to better home prices. And so we're seeing that it's not really all that rosy picture, though. Of course, when the U.S. Fed cuts, then a lot of the analysts say this is also going to boost the high yielders like Carry Properties and others. But it's going to take a little while because given that the Hong Kong rate cuts actually trail 6 to 9 months slower than the U.S. And also when we look at the sentiment, it's just the home buying sentiment is just not there yet. And also the falling home prices and the office vacancies has been weighing on the real estate sector in Hong Kong. And Hong Kong government actually has been auctioning off these lands for decades, and that's where the backbone of the Hong Kong's low tax system is. But then now with this falling prices and this vacancies in the offices again, this has been dragging down and pulling back a lot of the developers who have been going to the auctions. And so now this could potentially turn the tide and gradually have the market come back to that market again. And also we should remember that the Hong Kong government has been looking to lure in more of these talents from abroad, especially from China, through the talent programs by giving them and granting them visas for those talents and professionals who have graduated top universities per se.
Sang-Mi Cha, there, Asia Stocks reporter. Catch her story, of course. It's on the Bloomberg terminal here, how this might cause a positive jolt here to the Hong Kong property sector. Now, another big IPO that we're tracking here, effectively yesterday, massive move up in shares of Bajaj Housing Finance here, 140%, so that's effectively more than double. India's biggest new listing of the year, of course. Now, the home loan unit here, the country's biggest shadow lender, posting, well, the best first day gain, really, for a large Indian IPO of over 500 million. That's the biggest, or that's the best day on record. India's been on really been a global bright spot for capital raising, with stocks gaining more than 30% on average in their debuts this year. And by the way, just to mention too, right, so I think India is around number 3 or number 4 globally in terms of capital raised. Hong Kong was number 8. This listing today might actually get Hong Kong just below, if not just above, India. We're waiting for confirmation on that, but certainly the race is on. We'll be hearing, by the way, from Bajaj Housing Finance Chairman Sanjeev Bajaj later on Bloomberg Markets Asia, talking about, of course, that debut, what they plan to do with all that money. Catch that interview coming up at those times on your screens there. Steve.
Well, coming up, we speak with the former European Trade Commissioner, Lord Peter Mandelson, about UK and China relations as the EU moves ahead with tariffs on the world's second largest economy. You don't want to miss this. Stay tuned. This is Bloomberg. Also,
Right. Happy Tuesday morning. Welcome back to the show. Good morning if you're just joining us across the region. Good evening if you're joining us, by the way, out of the United States. Hope you're all well. A couple of markets are still shut in the region here because of the Mid-Autumn Festival. A couple of markets are coming back online. Malaysia, of course, is very much in focus at a reopening today. We were up as much as 32%, in fact, on this specific stock. Well, I'm going to try and make a fairly complex story simple for you guys. The U.S. has some tariffs that they're planning to impose on Chinese glove makers. And the conversation was back in May, it would be a certain rate. I think it was 25%, possibility that goes up to 50, even 100%. There's a note out of Citigroup today that could benefit some of the non-Chinese-based glove makers, and hence you are getting, as you can see on your screens, a reaction in the markets today. So this conversation around how do you trade geopolitical risk, how do you trade tariffs, it is showing up in the form of this. And of course, as we move into U.S. elections, do expect more of these stories to come further into the spotlight. Now, speaking of geopolitics, speaking of trade friction, speaking of a reset in trade relations, we're looking at ties now between the UK and China. Our next guest is a senior member of the Labour Party and a member of the House of Lords. Let's bring in, joining us here on set, Lord Peter Mandelson, former European Trade Commissioner and former British First Secretary of State. His political advisory firm, of course, consults with companies on navigating geopolitical tensions. It's very nice to see you, and thanks for taking the time to come in.
Back with Bloomberg
to speak with us. Perfect timing as well. This conversation around a labor reset with relations with China. How does that look like?
It looks like a re-engagement between Britain under the new Labour government and China. I mean, first of all, the government's going to undertake a very full audit of the relationship that we have, and that will obviously take account of the deep economic and trade and investment ties that exist between the two countries. But it will also reflect our concern about human rights, but also an assessment, a hard-headed assessment of the national security risks that we associate with China. So following this audit, a re-engagement will take place. The new government has signalled between Britain and China, and we hope that will make for a better, more stable relationship between the two countries.
Yeah, and just to get into the weed of things as well, help us to steer this conversation. I want to bring in, of course, my colleague here on set, Rebecca Chung-Wilkins, our Asia Governments and Economy correspondent. Rebecca.
Yes, I mean, what is, if I can push you a little bit further on that, what is the UK's top ask from Beijing? What is the #1 priority for the UK?
The top ask is of China that it plays its full responsible role together with other advanced economies in guiding and managing the global economy, but also its full role in the international system and international institutions so as to support the rules-based multilateral trading system, but also using its influence and its role where it can to resolve conflicts in the world. For example, I mean, the most consequential war, the most consequential conflict for those of us in Europe that's occurred since the Second World War is Russia's invasion of Ukraine. This is a major violation of a core tenet of international law, a major transgression of Ukraine's territorial sovereignty. That would normally attract utter condemnation from China. It hasn't. That surprises us, and it hangs like a cloud, frankly, over China's relationship with the whole of Europe. So we would want to see China taking a more responsible approach to that conflict, as it might do in other regions, conflictual regions of the world.
We spoke last year. You mentioned that Beijing, in some ways, had miscalculated, perhaps, the responsibility and the reaction to the alignment that Beijing made with Russia. Does China need a new foreign policy?
I don't think it needs new foreign policy. It certainly needs to reflect on how it's applying its foreign policy to that part of the world. Look, there is no defense. There is no justification for what Russia has done. I mean, Russia has mounted a colonial-style aggression against a neighboring country. It's the first time since the Second World War that we have seen borders, an attempt being made to change borders by force. Now, normally, that would attract complete condemnation, as I say, by China. China stands for territorial integrity, sovereignty, respect for other. Why doesn't it apply those principles of its foreign policy to other countries, and notably to Ukraine in this context? And I think that China, it took a wrong turning very seriously when it decided to align with Russia. I know China would say that it's not supplying battlefield weapons to Russia, but nonetheless, Russia would not be able to sustain its war on Ukraine without support from China, and that's what we would like to see changing now on China's part.
Is condemnation a minimum requirement for the UK to engage in this, to your point, this resetting of relations? And
then using its influence and its premier role in the world and in the international system to bring about a withdrawal by Russia from Ukraine and a settlement between the two countries so as to provide the basis for a lasting, durable peace between them. That's what we'd like to see.
Well, Beijing's position on Russia has contributed to sort of the global fracturing that we've seen, trade tensions also rising between the US and China. And I wonder, as the US is joining hands with partners around the world to impose this wall of tariffs on China, how are you advising companies at Global Counsel on how to navigate these trade tensions, and what are their biggest concerns?
What's happening in international trade is that, to all intents and purposes, it's being reshaped. Globalization is being reshaped. It's not being upturned, but we're seeing increasingly trade taking place along geopolitical lines. Now, international companies have got to navigate those geopolitics and those new lines which are emerging. They've got to take full account of them. And what many people, some governments, many members of the public are seeing in the interdependencies between countries and between economies, which we once saw as a great benefit, as a great source of prosperity, now they're seeing as a source of danger or insecurity. Now, I think that danger and that insecurity is overblown. But nonetheless, we do have to take account of the fact that between the United States and China, a rupture has emerged. This is a very strong headwind blowing across the global economy. And companies, international companies, need to navigate that. And Global Counsel, my own firm, is there to help them do so.
Along the same lines, do you think the UK should follow its allies, particularly in Europe, and I think they're about to vote on this, what those tariffs eventually look like in a couple of weeks. Should they follow Europe in imposing tariffs on Chinese EVs, for example?
That's a matter for the British government, and I know they're considering that. Look, the disposition of the government in Britain is towards a open economy. It's a disposition towards reducing barriers to trade, not increasing them. And of course, one of the major concerns for the British government is, wherever possible, to reduce the cost of the energy transition and the path towards net zero that the government is taking in a very, very systematic and very conscientious way. And therefore, it would need to balance the desire by some, as we're seeing in the European Union, to safeguard domestic production against cheaper production from China, with the desire to minimize the cost to the consumer of the electric vehicles that we're encouraging people to buy.
Well, we're waiting to see a formalised industrial policy from the Labour government, but you've been, you're a former European Trade Commissioner, first Secretary of State, you've held numerous positions in government. Do you want a job in this Labour government, and what job do you want?
I'm very, very happy representing my country's interests and reflecting the government's policies and points of view around the world as I travel, and in undertaking wonderful interviews like this with Bloomberg.
Okay, well, how would that exercise be best expressed? In what position, ideally speaking? Let me push you on that.
I am what I am. I'm a former Trade Commissioner and First Secretary of State. I speak with a lot of knowledge and I hope insight about what's going on in the world. My job here is to support the new Labour government in Britain, and heaven knows it's got an enormous amount to repair, to rebuild and reconstruct in our country after the last decade. And in any way I can help that, I will do so, and otherwise I'll be getting on with my day job.
So one of the many day jobs that you might be adding to your repertoire is Oxford Chancellor. You've thrown your hat in the ring for that gig. And I'm interested. So the UK higher education is a really important part of soft power in the UK. At the same time, we've seen that Chinese students are contributing about 25% of funding to leading universities. I'm interested in your take. Do you think there are risks here of becoming overly reliant on Chinese students? And particularly at this moment where we're seeing people-to-people ties in some areas really start to falter?
Well, we want to encourage people-to-people ties, not to discourage them or put barriers in the way of them. Look, Oxford University is a top rank, one of the top global universities in the world, both for its college-based teaching and its research. It has a premier science and technology base, and in my view, Britain's future prosperity is going to be built on the shoulders of that research and the commercialization of that research that is undertaken in Oxford University, amongst others. I'm standing to be the figurehead of Oxford because I deeply love the university, I believe in its values, and I think that I can help Oxford reach out to governments, international networks, businesses and philanthropists to help maintain those standards of excellence which we associate with Oxford University. And that's why I'm running. But this is really important, not just for Oxford, but for Britain as a whole. We want to encourage people to come to Britain. Higher education is one of our chief exports, so of course we want people to come and learn and advance their knowledge at Oxford, but we also want to attract the top academic talent as well. I'm sorry that the previous British government set out to dampen that and to put barriers in the way. We're not going to do the same now under the new Labour government.
It was a pleasure to speak with you and see you here. Of course, let's do this again, and we'll see in what capacity next time. Lord Peter Mandelson, their former European Trade Commissioner and former British First Secretary of State, and of course our Asia government and economy correspondent Rebecca Chung-Wilkins. Plenty more ahead here on The China Show. Okay, we're looking at you're looking at a board here of some of the Apple-related stocks in the Asia Pacific, really on the back of, I think, some reports of tepid, lackluster, lukewarm. What descriptor do you need? In terms of these pre-orders for the iPhone 16, that being said, we're not really seeing a reaction in the supplier space. We did get, though, a little bit of a pullback in Apple in the after-hours session here. Global macro movers for you. Let's get it up, please, if we can. We're looking at declines here on the benchmark itself, although, as you can see, most stocks might be on the up, although volumes are wanting. Plenty more ahead in the second hour of the China Show. Welcome back. You're watching the China Show. Welcome to the second hour of the program. Welcome to the second trading day of the week. So, yep, it is still early in the week. Hope still runs deep. I wonder what ill-informed investment advice we'll be getting this week so far. Fingers crossed. Banter aside, of course. We're looking at gains on the Hang Seng Index. So this should be actually a fourth day of gains in Hang Seng. So we did shake off the initial cobwebs on the benchmark itself, 0.8%. HS Tech should also be putting higher into the session too. The other big story in Hong Kong today, well, the two big stories in Hong Kong. One is, of course, Chief Executive John Lee resumes his weekly briefings. Number one. Number two is the biggest listing in Hong Kong in 3 years with his company, of course, which was traded already onshore, listing in Hong Kong, massively oversubscribed, upsized as well, and as you can see, doing very well for listing this size, which all really the superlatives into that statement, 8% in the first 30 minutes of the session. We talk about the Fed and the Fed conversation here with lower rates and what that actually means for Hong Kong property. We're also seeing a fourth day of gains across some of these counters here. The Hang Seng Property Index is up for a fourth straight day, as you can see, and with HIBOR now falling to nearing the lowest since May 2023, could actually help things along. We have, in fact, a deep dive piece into how this might help, of course, this group of stocks moving forward. Very quickly, Asia ex-China, several markets are still shut, including mainland China today, including Taiwan and several other markets across the region. We're down 0.25% on price. On the benchmark, we're down about, last I checked, about 20% as far as volumes are concerned. There is, of course, that story, the big one, which is the Fed.
Absolutely. We heard from former New York Fed President Bill Dudley backing a 50 basis point cut in rates at the upcoming FOMC meeting.
The market has come to the view that 50 basis points at this meeting is, in fact, appropriate. It's pretty important that the Fed head back to neutral expeditiously, and that 25 basis points wasn't fast enough.
All right, so let's take a look at various, I think, windows into market positioning ahead of the Fed. You're looking at equity markets, you're looking at options, you're looking at the most active S&P. And, of course, not to call direction here, but the most active in terms of volumes are mostly put options at those strikes. And, of course, that would tend to profit in the event we do get declines into that expiry. September 18th is when the Fed comes out with that decision as well. Keep that in mind. Treasuries have come down substantially. I think we're at 3.5%, give or take, on a 2-year, maybe 4% on the 30-year. And, of course, your 10 years at about 3.6%. Is it, I mean, do you still add duration at these levels, given how far we've come down? And very, very quickly, as far as pricing goes, the big conversation this week, do we get 25, do we get 50? Currently, swaps are predicting, and let's just call it a coin toss here, 50-50 probability of a larger 50 basis point cut. Right, let's bring in Jack McIntyre, portfolio manager at Brandywine Global, joining us right now to talk us through this. Jack, I was having a look at my history books. The last time the Fed started an easing cycle by doing 50 was also on September 18, 2007. We all know what happened back then. It's hardly the environment now compared to what we had back in that year. Why should the Fed move by 50?
Yeah, David, that's a great point, because we're not in crisis mode. I mean, the economy is probably transitioning from maybe, hey, looking at like a hard landing to soft landing. But why should they move 50? I think, with the hindsight being 2020, they should have moved in July. So they were going to do 25, and then you add 25 in September. That kind of gets them to where they should be. And, we're going to talk about inflation, but, employment is the critical variable. It's starting to to soften and maybe even soften at an accelerating rate. And we know that's a very lagging economic indicator. So they need to do 50. And then, but I think what they also need to do, though, is kind of send a message, and they've got plenty of ways to do that, of saying that, hey, we're going to do 50, and then we're going to kind of have to see if the data warrants another 50, or your expectations should be just a series of 25.
Well, Jack, Steve Engle here. I mean, you said the Fed obviously is playing catch up. They should have moved. They should have cut back in July. Does a 25 or 50 basis point cut this week give you a better indication of the pace and depth of future cuts over the next year?
So, I don't want to read too much into what they do this week. I think one of the things, when they give us the dot plots and the summary economic projections, I think that's going to be a source of some very interesting information, because I think what's also critical is also not just the pace of rate cuts, but what is the terminal rate? Because kind of figuring out where 10-year yields might go based on that terminal rate. And if it's 3%, then treasuries probably are a little expensive when they get close. 10-year treasuries are a little expensive when they get closer to 3.5%.
Well, okay, we are at, let's call it 3.5%.
Yeah.
Well, 3.6 on the 10-year. Would you be adding duration at this point in time, Jack?
Dave, I'm taking the other side of it. We're actually starting to cut back on here. Treasuries have had a great run. Again, I think part of this whole move with the Fed cutting is that it increased the odds of a soft landing. We've seen a lot of volatility around the market in terms of hard landing, soft landing. There was a period in April, no landing. Earlier, in July, we kind of said hard landing, but I think soft landing is the way to be positioned. And if we're right, there's other types of bonds we want to own other than U.S. Treasuries. So we are cutting back, and if we get closer to 3.5, we're going to turn neutral on Treasuries.
Jack, what is your outlook for U.S. inflation? I mean, you say it's all about employment right now, not necessarily about inflation, but we have an election cycle. Obviously, you have two different views on how to combat or what policies could lead to future inflation as it relates to, obviously, supply chains in China. What is your essential outlook, given the uncertainty of the election campaign, and also given the employment situation is what you say is the biggest reason to cut?
Yeah, so, okay, tying in the labor statistics. So, with the labor market softening, it means wages are coming down. So that's good from a service standpoint. And I think it's kind of going to get service inflation kind of mirroring a little bit of what happened in goods inflation, where it came down more meaningfully. Having said that, though, and you pointed out, the wild card is the U.S. election, because one of the things that's been very different on this cycle is that fiscal impulse. And we've got to see how that sort of plays out. I think divided government is probably the best sort of avenue, being a bond person. We don't want necessarily any particular party to sweep, but that's going to be a wild card. But again, I do think, and it's probably less important, my confidence that inflation is heading lower, and it's more about the Fed has a lot more confidence that inflation's heading lower. So it gives them the green light to start a rate cut cycle.
Okay, and once they do that, you mentioned earlier on, it certainly increases the probability we'll get a soft landing as well. If my business is not in treasuries, where do I look? Where is a decent carry out there, Jack?
So, yeah, and I'm going to quickly just mention, China continues to be a source of deflation. So that means yields and global inflation should be well behaved, and the yields look good. And in the soft landing scenario, I like emerging markets, developing markets. Again, their central banks acted early in trying to break the back of inflation. The hard landing is they're not going to be the type of bonds that you want to be invested in. They're not going to hold their value. But the soft landing, capital is going to gravitate towards yield. And there's some very attractive inflation-adjusted yields in the developing world. So we're moving back into, for instance, Mexico, and bonos look very attractive. Again, there's some political uncertainty, but we think you're being more than compensated for it by owning those and bonos unhedged, so being exposed to the Mexican peso as well.
Yeah, we have, central bank decisions in Japan as well. That yield differential has come down. We've seen an increase in the Japanese yen. How do you see that potentially playing into your portfolio?
Yeah, so we have actually been overweight the Japanese yen. For that, it's a way of actually getting exposure to the U.S. front end as well. I mean, it's not just all about the BOJ, but this sort of more potentially aggressive move by the Fed. But we've been cutting back. We're neutral on the yen. A lot of these things have all moved. The yen Treasury yields. I agree. The BOJ is not done tightening. I don't want to own JGBs, but the yen's moved a lot, and I just think, and the U.S. dollar's weakened a lot. So my mindset is that we need to consolidate a little bit, and I think we're going to get better levels to reduce our U.S. dollar exposure.
Oh yeah, I was going to ask you that as well, because the market's already gone light on dollar allocations. What is your prescription now? What levels do I wait for specifically?
Yeah, well, it's always kind of get really nuanced exactly where you want to do it. I almost want to get through the U.S. election and figure out what the outcome is before I want to kind of go back into being a meaningful sort of underweight the U.S. dollar, because there is a lot of uncertainty around that election and what sort of potential tax policies are going to go through. And I think that uncertainty around the election is probably manifesting itself a little bit more by the U.S. corporate sector kind of waiting as well. And I think that actually could soften the U.S. economy, but not enough to want us to get back in a more significant underweight the U.S. dollar.
Jack, we'll let you go because I know you're doing something else. But on that very note, in 10 seconds or so, the Eagles are playing the Falcons. Third quarter, I think 4 minutes left. Who takes this one?
I'm going to say the Eagles, but it's tough. They better turn it around because they don't look that good.
All right, Jack McIntyre, Eagles fan. All right, portfolio manager at Brandywine Global. Thanks so much for joining us here on the China Show. Let's go Seahawks. Okay, sorry, I had to throw that in. Coming up, Intel to make custom AI chips for Amazon, boosting Intel's chief's efforts to turn around the chip maker. Details next. And of course, this is Bloomberg.
Right, we're looking at shares of appliance maker here in the city, and the question was going into this because it was oversubscribed, it was upsized. Were shares going to go hot in the microwave up or down the drain? It's the former biggest listing in Hong Kong in 3 years. Ada Lee joins us right now. She looks at the company, she looks at the industry, Bloomberg Intelligence senior analyst. So they now have a fair amount of cash, $4 billion. What do they probably use it for?
Yes, so they have actually been in very good equity position or balance sheet position with the net debt to EBITDA since 2020 below 1 time. So that is actually very strong balance sheet. And what we think that they'll be using this proceed for is firstly to boost international interest, both from the investors and consumer alike. Secondly, they could use this to pay for certain M&A activities. For the past 10 years, they've been doing a lot of M&A activities globally. They have bought Toshiba brand, Comfy, Eureka brand, and remember last year there was also a rumor about a deal buying the Swedish home appliances company Electrolux. So for them to fuel the global ambition, I think this proceed from the Hong Kong listing could help them. Thirdly is because they have been growing internationally, they have quite a number of staffs overseas or outside of China. So this listing could also give them a medium for potential equity incentives.
How critical is this international ambition, given the state of the domestic economy? We know the government has launched a appliance trade-in program. I've heard mixed views on whether that is actually going to be working, given the state of the economy right now. But is it critical that they go abroad?
Well, they are currently about 40% of the sales is from the global business already. So I think it has always been in the ambition to go overseas and also to diversify their risk, from just being concentrated in China. So currently they are actually the largest air conditioner company in China by market share, having surpassed that of Gree. And, with the New for All program, I think there's definitely some short-term boost coming through, especially on the upcoming Singles Day. But how effective that is, it's way to be seen because of the state of the economy and also people's willingness to actually trade in the old home appliances. If you look at it historically, home appliances are normally purchased when you buy new properties. And that's the key stimulus or key drivers for home appliances growth. But nowadays, for them to swap out the old one, normally what happens is only when it's broken, you swap it out. So a fridge typically can last for 8 to 10 years. But in the olden days, it seems like the quality is actually quite good. So sometimes it can last till 15 years. Do people want to swap it in before it's broken? It's something to be seen.
Yeah, I have stuff in my fridge. It's actually older than the fridge itself. That's probably, okay. Yeah. No, don't go there.
I'd save that inside your brain.
Going beyond the company itself and the stock, right? This had a lot of significance too as far as Hong Kong. What does this mean for Hong Kong? The fact that it's up, and why did it choose Hong Kong? Because this is already listed, I think it's in Shenzhen.
Yes.
Yeah.
So firstly, it's great news that it's finally up. I think it's great news ahead of the Mid-Autumn Festival. I think it's just something for us to celebrate. I think in terms of Hong Kong, if you look at it, it is the largest listing year to date in Hong Kong. But when you look at globally, it is actually the second largest globally after the Lineage, which was listed in Nasdaq in June this year. So it is a massive listing on a global level as well. Why is Hong Kong important is I think it will provide Midea a platform to attract more international interest and then also boost its liquidity. So I think it is very important for Midea itself, but for the Hong Kong listing, it will pave the way, or what we believe is it will pave the way for other potential listings. So year to date, there have been quite a few number of potential candidates withdrawing or halting their application on the Hong Kong listing. And we think this successful IPO could pave the way for other companies, one of which we're watching closely is China Resources Beverages. They are the largest bottled water company in China's in terms of still water, and we're waiting for them to list.
Well, Bonnie Chan, that's music to her ears as the Hong Kong Stock Exchange chief executive, as her pipeline is starting to come to fruition, obviously. All right, that's Bloomberg Intelligence senior analyst Ada Lee. Thanks so much for joining us. Another listing we're following is Bajaj Housing Finance. Shares more than doubled in India's biggest new listing of the year, the home loan unit of the country's biggest shadow lender, posting the biggest first-day gain for a large Indian IPO, over $500 million on record. India's been a global bright spot for capital raising, with stocks gaining more than 30% on average in the debuts this year. And we'll be hearing from the Bajaj Housing Finance chairman, Sanjeev Bajaj, later on Bloomberg Markets Asia, discussing the firm's trading debut and corporate outlook. You can catch that interview at the times listed on your screen. All right, many more ahead on the day of the Midea listing, obviously here in Hong Kong. More on that. This is Bloomberg.
In the latest episode of the Tiger Money podcast, I spoke exclusively with Vanguard Australia's head of investments, Duncan Burns, on what is needed for one to actually outperform the market, and how does one actually gain the skills to do so.
50 years ago, our Aussie market, and really equity markets around the world, they were largely non-professional. So a lot of retail players and professionals were a smaller segment of the market. And, fast forward to today, where most major markets, including Oz, they are dominated by pros. So 90% plus of daily turnover in the market is professional. And if we bring in the derivative markets, that number pushes up to like 98 or 99%. And what's happening there is increasingly the amateurs are shifting to professional funds and index funds. the easy money, or it's somewhat of a mean term here, but willing losers, they're dropping out of the market. And in essence, the active is getting harder every year because the market is now dominated by professional investors. And again, the big problem for active investors is that edge, like it's pros versus pros, and the markets are getting more efficient and they're getting harder. So would love to touch on skill if this is something of interest as we think about, manager skill and how are they getting that edge and how that's changed over the years.
The late great Charlie Munger in one of those annual meetings, of course, I forget which one, but he said all he has to do is, and I'm paraphrasing, outperform idiots. And he said, thank God that the world is full of them. And I just have to be somewhat just half a step ahead of idiots. So how do I develop skill?
Active managers of today, they've got CFAs, PhDs, Bloombergs, data feeds, accounting info, AI, machine learning, better systems, algorithms. And, we talked about performance earlier. I'm like, why aren't the active managers doing better with all that skill and all that technology? And a bit of a paradox here. And the answer is in relative skill. And we were just talking about absolute skill. If we look at relative skill, again, the spread of skill among market participants, kind of going back to the professionals and the non-professionals, that has really narrowed over the years and over the decades. And all investors today are a whole lot smarter. And asset management, again, largely professionalized. A lot of those non-pros have turned to indexing and pros for better results. And the variance in the skill set of market participants has really dropped. And that matters. Again, what active managers want are weaker players introduced back into the market so they can express their skill. And, as I talk to clients about this, I love to use an analogy. It kind of reminds me of my friendly neighborhood poker game. And we get players in there of varying skills.
Okay, you can catch the full episode of the Tiger Money podcast, the latest one, out now today. The podcast has dropped. Apple, on Spotify and YouTube, and also on Bloomberg.com. New episodes, of course, debut bi-weekly every Tuesday. Right, a couple of things across these markets as we go into the Japanese lunch break. We'll pivot now to Southeast Asia. You're looking at the Straits Times Index over 20 years. The index is now within 1% of that high it hit back in 2018. And beyond that, we're back to levels last seen back before the global financial crisis. So it's not just the weather that's hot in Singapore. Glove makers also in focus, Steve. We were talking about this earlier on.
Yeah, well, I mean, again, they got a bit of a boost on the Biden administration had talked about doing quite high tariffs on PPE, personal protective equipment, including rubber gloves. But Singapore is an interesting story, too, that we're going to talk about probably a little bit later. Capital Land said to be in talks with Fosun International, the big Chinese private equity group and conglomerate, essentially, for a between 30%, about 20 to 30% stake in Club Med. So that would be a very interesting deal that comes, as Fosun is trying to pare back some of its debt and get back to its past glory.
Yeah, and some of the assets it picked up along the way. Let's put it that way.
Quite a few. Foley, Thomas Cook, Club Med, Cirque du Soleil, Rock Oil in Australia, Wolverhampton Wanderers FC.
Oh, did they pick that up too?
Yeah, Guo Guangchang, the chairman. Yeah.
Wonder if they helped them on the pitch. Anyway, we can talk about it later. Apple suppliers in Japan. We talked about Apple, right? So some disappointing, weaker than expected. Let's put it that way. iPhone 16 and some of the pre-sales coming through. So the stock actually fell. And we're looking at some of these suppliers that are listed over in Japan going into the lunch break, also seeing declines in that market. Right, good morning. Welcome back to Shows. We're headed into the Tokyo lunch break right now. And, we over-obsess over the Fed, as we should. Don't forget there's a BOJ meeting that might give us something to talk about as we wrap up this week. Nikkei is down about 2%. You look at the latest CFTC data. So the market's gone from absolutely bearish on the yen. It's gone back to neutral, even slightly bullish on positioning. The latest data suggests we're back slightly more bearish right now, just to give you a sense of positioning right now ahead of the Fed and also the Bank of Japan. Right. Let's pivot and have a look at some of the suppliers of Intel. So before the break, we had a look at the Apple conversation and around the lackluster sales of the iPhone 16. And if you've added to the cash pile of Apple, congratulations to you and the company. Intel, of course, is a separate conversation here with, well, the new plans of Intel and what the projects that they've needed to put on ice to prioritize, of course, this pivot and refocusing of the company. Some of the related names in Japan, as you can see, declines there just about across the board there, Steve.
Yeah, let's talk a lot of tech right now. Bloomberg Intelligence senior analyst Robert Lee joins us now. So Intel to make custom AI chips for Amazon. What's the trade-off, though? As they do that, they might have to deprioritize other things.
That's true. I think, as I've said before, I mean, one of the primary challenges that Intel has is it's a very cost-heavy business. It's following this traditional integrated device manufacturing model, or referred to as IDM. So if you look at their headcount, Intel's total headcount exceeds the combined headcount of NVIDIA and TSMC. So it's carrying a lot of cost. So I guess they need to understand and prioritize on where they're going to get the best and quickest return. So clearly that's the foundry business, and the news with Amazon demonstrates that there is still value in their proposition and will obviously benefit sentiment, in fact, given that they are potentially looking to add to their customer base and broaden out. So I think this should overall give a lift to sentiment. You've seen that reflected in the stock price overnight. But, Intel's fundamental challenges remained. It's a very cost-intensive business. They're laying off 15% of staff towards the end of the year, as you know, as a first effort to try and rationalize that cost base a little bit.
Yeah. So you mentioned NVIDIA. Foundry, of course, within the Intel conversation is a very complex one, too. The other story I want to get your take on was, I think the information came out with a scoop of ByteDance looking to develop its own chips and using TSMC, I believe, as the foundry there. Do you think they'll be able to do that?
Well, that's
2026, I believe, is the timeline.
Yeah, that's right. My first reaction when I saw that story, and it is unconfirmed based on, whatever, obviously, geopolitics is impacting the world of semiconductors at the moment. So for a leading Chinese firm to be placing orders with TSMC, which, who's obviously aligned with the US and aligned, in a separate camp, on the face of it, doesn't make a lot of sense. However, I think it could be possible, as long as whatever chips do come forth from this relationship, if it is confirmed, that is, comply with the current US export restrictions. But having said that, we've obviously seen a progressive tightening of those technology and export restrictions. So the risk is, if this story is correct, that we could see a further tightening, which could, completely forestall this new developing relationship on that front. And taking a step back, why is ByteDance looking to do this? Again, with the export restrictions on NVIDIA chips at the moment, there is increased, obviously demand isn't an issue within the world of AI. They need to try and get their hands on high-end accelerator chips. So by designing their own, trying to work around this export restrictions and NVIDIA bottleneck, is the obvious strategy for them to enact. But I would have guessed that they're more likely to do a deal with a local foundry like SMIC rather than TSMC, given the heavy level of geopolitics impacting the sector at the moment. So it doesn't quite make sense, to be honest. But this is an unsubstantiated story.
Robert, we have another story that's crossed this morning here in Hong Kong about AI, and apparently the Hong Kong government is looking at drafting its, or has drafted its maiden policy speech, I guess, or policy stance on the use of AI for the finance industry. Is this something to limit its use because of moral hazard, or to enhance what is obviously an international financial center here?
I would say probably more the latter, in that, Hong Kong, what is Hong Kong these days, apart from a great place to live? It's a major financial center. So obviously there are pressures. A lot of the business that's come in through the coffers of Hong Kong in recent years has been related to mainland China. Hong Kong as a city needs to reposition itself and develop new economic growth drivers. It's tried to do that within fintech, and I think, with the news you've heard today, is trying to do something similar on the AI line, in a greater effort to attract talent into the city. And Hong Kong is ultimately a service-based economy, isn't it? So I think the future growth drivers for the Hong Kong economy are more likely in the fintech and AI side than other areas. So this piece of policy direction is trying to, give the market a bit of a steer and give some high-level support as to the way the governing body wants the economy to develop here. I think that's the core of it.
Fantastic. We're looking forward to that. I know who to call when that news comes out, of course. Robert Lee there, our Bloomberg Intelligence senior analyst. Some other corporate stories that we're following right now. Amazon CEO Andy Jassy is moving to streamline the world's largest online retailer and cloud computing company, and the firm is cutting management layers and ordering employees to return to the office 5 days a week beginning January of next year. Now, Jassy announced the shakeup in a memo to employees on Monday and says Amazon wants to operate like the world's largest startup. Right, Microsoft has unveiled a new $60 billion stock buyback program, matching its largest ever repurchase authorization. Now, the company says shareholders will also receive a quarterly dividend of 83 cents a share. That's compared with the current one of 75 cents from November. Now, the share repurchase agreement replaces the buyback program announced back, if you remember, back in 2021. Right. Singapore's capital land, Steve and I were talking about this earlier on, is said to be in advanced talks to buy a minority stake in French luxury resort chain Club Med from its Chinese owner, Fosun International. Now, sources say Capital Land is looking to acquire up to 30% in the company here for several $100 million. It comes as Fosun steps up efforts to lower its debt burden, including disposing of assets and also reducing some of its borrowings.
Well, Dave, turning to Shanghai now, it's reeling from the strongest typhoon to hit the city.
Massive one.
Get this, in 7 decades, since 1949, the founding of the People's Republic of China. We had, obviously, flight cancellations last night, Dave. We had 3 inches of rain, I believe. It really did pummel the financial center. And came at a time, obviously, that China's had a number of different weather incidents across the country, whether it's drought and flooding. It was also the hottest July on record in China. And then during the Mid-Autumn Festival, I guess not as many mooncakes were given out and sold and consumed during the Mid-Autumn Festival because people were stuck inside.
And, what a time for such an extreme weather system to hit, to your point, right, during the holidays when people would travel. I mean, these are crazy pictures coming out.
Well, it's extremely rare for a direct hit coming from the ocean from that high north. They usually come up along the coast, right. Up, Fujian, then up, and then skirt Shanghai. This one was a direct hit.
Yeah, it went between Taiwan and Japan. It usually hits either the Philippines or Taiwan, goes into the middle and climbs up the coast. So I guess let's get a sense of what the economic losses might be looking like here.
Yes, let's bring in Stephen Lamb, Bloomberg Intelligence insurance analyst. Stephen, what is going to be the cost of this one?
Yeah, thank you, Stephen, and thank you, David. So, our initial estimate is that about 5 to 10 billion yuan could be the economic loss. Now, translate that into dollars, so it's as high as about $1.4 billion. Now, how do we come up with that number? Remember back in July, we actually have a typhoon called Gemei. And that hit that had a similar wind speed, and the damaged province were mostly concentrated, like what Stephen said, started in Fujian and then inland, right? Now, imagine right now, because this is called what the locals call the bullet typhoon, it went straight to Shanghai directly, and across Jiangsu province, very, very densely, even more economically vibrant than Fujian province, right? So that's why we sort of give a little bit of buffer that this could be higher than Gemei. And another reason is because of higher insurance penetration. Usually, these areas are more educated in terms of insurance protection, more cars, more factories and whatnot. So property values are definitely higher than the previous one. Now, not to mention about Yagi. Right, Yagi hit Hainan. Right now, that is a much bigger, much deadlier, much stronger typhoon. I guess the key takeaway from this time is that imagine if Yagi actually went to Shanghai, what would happen, right? That would be a devastating situation, yeah.
Right. And there's another one coming, I think, which we can talk about later. But so get us up to speed here. Year-to-date losses, and how do we extrapolate from year-to-date to the total we have, the estimate for this one, which is 10 billion RMB, into the full-year figure?
Right. So the 10-year average for China, natural catastrophe losses in terms of economic losses would be about 329 billion yuan. That's about 46 billion in terms of dollars. We believe, based on this one and the previous ones combined, we're actually quite on track to meet that or even exceed that for this season. The reason why I say that is because, on average, you actually have 3 strong typhoon landfalls in China, right? We already got 3. And we still got at least 2 months left in the season.
There's another one. I'm just looking at the Hong Kong Meteorological's website. Pulasan is on its way. Another bullet, as you said, straight into the eastern seaboard.
Yeah. I think what's scary about these for the last few years is that the bullet ones, what happens is that it didn't take them too long to form and then hit mainland. Usually they come from Guam or come right in the middle of the Pacific, right? But these ones, usually they can form probably a few hundred kilometers east of Philippines and then went straight to China.
So in terms of which insurers might be most exposed here, how do we look at that? How do we look at that conversation?
Yeah, so the most exposed ones definitely will be PICC, because that's the only business they have is P&C insurance. Now, of course, these companies, they actually run themselves pretty good in terms of balancing between underwriting margin and investment income. So the investment income can be the buffer. That's the number one buffer. The other one is their underwriting margin. So these guys run about 2.5% in terms of underwriting margin. So that's their buffer. In terms of earnings impact, I think if you shave 1 percentage point off of their underwriting margin, that's about 13% of their earnings for this year.
Stephen Lam, thank you so much. Our Bloomberg insurance analyst there, tallying up the potential losses, and of course this other one that's, as the track looking like another direct hit. We'll see, and hopefully that obviously changes. Plenty more ahead. This is Bloomberg.
And welcome back to the China Show. Barclays says any effort by a second Donald Trump administration to intentionally weaken the dollar will face tall hurdles. Trump earlier told Bloomberg Businessweek that a strong dollar was a, quote, tremendous burden. The bank strategists say capturing the Fed and intervening unilaterally are too costly to be plausible, quote unquote. They say fiscal tightening may be the best way, but a political unpopular opinion. Separately, Barclays sees Trump's proposed 10% universal tariffs supporting the greenback by as much as 3 to 4%.
Yeah, let's talk more about some of these plans here from the former president. And I think you might have heard it. I think it was either last week or the week before. Conversations around tariffs if you don't use the U.S. dollar. And maybe, just maybe, of course, the former president is looking to capitalize there on the second attempt on his life in recent months. And sources are telling us that Donald Trump will continue to campaign. His campaign scheduled this week, just 50 days out, of course, it's 50 days to Election Day. Let's begin our senior Washington correspondent, Saleha Mohsen, joining us right now to talk us through really where we are in this, as far as the economic agenda is concerned. And we discussed this a few seconds back here. What is the rationale behind Trump looking to impose additional tariffs on countries that either are abandoning the dollar or don't use the dollar to begin with?
Well, I do love that everywhere I go in the world, people know exactly how many days until the U.S. presidential election. So we're 50 days out. You're asking me about tariffs and the dollar. Trump is talking about wanting to put 100% tariffs on any country that abandons the dollar. And what that is doing is it's a bit of a misunderstanding of how de-dollarization could or would work. Now, the BRICS Plus Club, which is growing in its clout and growing in its membership, is meeting next month in Russia. President Xi Jinping from China is reportedly traveling for the summit, and we'll see after that any de-dollarization effort would be a very slow shift away from the dollar. So applying sanctions or tariffs, 100% tariffs would actually be a little bit of a confusing signal to send.
Saleha, Stephen Engle here. Do we know really enough about either Trump's or Kamala Harris's economic policies for investors to kind of decide, okay, stocks, bonds, alternatives, what?
Well, what's interesting is that September and October, this is when we see investors really start paying attention to the presidential campaign. Washington is watching from day one. This is when investors and strategists start chiming in. But because it's such an untraditional, wild election year that is unfolding with a new candidate at the top of the Democratic ticket and then Trump, we're seeing that there's a paucity of economic agenda planning out there. We don't know much about Harris's agenda. Trump, we know, can be sort of shoot from the hip, a little bit volatile. So markets are doing a lot of tea leaf reading, seeing what all we get from the campaign rallies and debates and other speeches. But there's not a lot of information. It still kind of remains to be seen what would happen with tax cuts expiring next year, what would happen with economic statecraft, and how. But one thing is clear, I will tell you, is that none of these candidates care about the federal deficit in the U.S.
Well, okay, yeah, I think that a lot more people in common with that. Do the two candidates have anything in common as far as the economic platform or anything else that might be concerned there?
Yeah, they do, actually. One thing that is very clear about the U.S. is that economic populism and protectionism are here to stay. Trump changed the Republican Party, but he also changed the Democratic Party, making them more of a Buy America, promoting U.S. manufacturing, and raising some trade barriers, making them more of a populist party.
Our senior Washington correspondent there. Joining us, of course, here in the region, Saleha Mohsin there. And, of course, Saleha is the author of Paper Soldiers, How the Weaponization of the Dollar Changed the World Order. The Chinese and Korean translations of that book will be released later this month, so keep an eye, of course, on that.
Well, Dave, Donald Trump was speaking earlier about the cryptocurrency industry. If elected, Trump says he would aim to turn the U.S. into a global crypto hub. Take a listen.
My attitude is different. If we don't do it, China's going to do it. China's doing it anyway. They are. But if we don't do it, we're not going to be the biggest, and we have to be the biggest and the best.
Yeah. So I think the verbatim of that was, if the U.S. doesn't undertake this project, Steve, China's going to do it. Maybe just to fact check the former president there, China's policy actually towards crypto is.
It's not allowed.
It's not allowed at all.
They were doing mining, obviously, cryptocurrency mining. They banned that. They have been very cautious on that. Whereas Hong Kong is looking at having, of course, they have the crypto exchange here.
The virtual asset policy.
Yeah. So, again, maybe we need to fact check a little bit about that, whether China would do it if the United States doesn't. But it's an election campaign, Dave.
Maybe Donald Trump meant Hong Kong anyway as part of China, which it is. But it's a separate jurisdiction as it pertains to crypto policy.
Yeah.
Specifically. All right, there we go. Bitcoin up a little bit, maybe not down to this news here, but anyway, it's up. Plenty more ahead. This is Bloomberg. Pony Ma, the co-founder of Tencent, has once again reclaimed the title of China's richest person as the firm rides its gaming resurgence in the country. For that and other factors that might have contributed, of course, to the title, going back to Pony Ma, Min Lo, our China correspondent, has this report. Min, what do you have?
Yeah, I guess it speaks to the volatility of the Chinese stock market that you have three people taking the top spot in nearly as many months, because last month you have Colin Huang, the founder of PDD, taking the top spot for just 18 days before surprising investors with his weak outlook of the economy and his company's performance, and that wiped off billions of his net worth. And this is him, the yellow line coming down here, and he was overtaken by Zhong Shanshan. That's the white line over here. He is the founder of Nongfu Springs, which is the water and beverage company. But we had that very weak macro data coming out in August, and it also reflects a deep slump in the consumer staples sector, which is the second worst performing sector in in China right after real estate. So he's slipping down the rankings. And coming up, taking over his place now is Tencent's Jack Ma. There you go. The blockbuster games of Black Myth, Wukong, DNF, really propelling the company to outperform the other similarly sized rivals. And this comes, by the way, as Tony Ma is riding this resurgence of the gaming sector, but also after Beijing spent the better part of 2 years to, crack down on the tech sector and the billionaire tycoons, the likes of Alibaba and Didi was in the crosshairs. Tencent wasn't spared as well. It has it had to downsize and sell off some of its stakes in its e-commerce and gaming assets as well. And so now you have it, I guess towards the end of 2022, you started to see signs that Beijing was relenting on this crackdown, perhaps driven by the need to, get these companies help to revive the economy. And so Pony Ma taking back the top spot here, but about 40% poorer than he was back in his at the peak of his wealth in January 2021, where his wealth was later eroded because of Beijing's crackdown into the video gaming sector targeted at children.
Okay, yeah, 40% poorer, but I can guarantee you're not hungry. Right? There we go. Min Low, thank you so much. What is it, $44 billion?
Yeah, not bad.
Yeah, still.
But again, it does reflect the pain that we've seen in the stock markets, and people's paper wealth has come down, and also the pain in the economy. And also, you don't really want to be on these lists.
No.
With common prosperity, it's just low profile right now. Keep your head low.
Yeah, I mean, to Steve's point just now, right? The conversations around. It used to be, you look at the top 10 biggest, when you looked at the top 10 biggest companies by value a couple of years back, I mean, Alibaba was a constant feature there. Tencent, I think 2007 even had PetroChina at one point was the first $1 trillion company, if I remember correctly, very, very briefly. ICBC. And then because of the changing and the fortunes of the markets, these Chinese companies have really slipped down.
Sure, well, the crackdown on the platform economy really had a lot of wealth destroying effects.
Yeah, poor guys. $44 billion. What does one do with only $44 billion these days? Very briefly, markets are looking like this, 31% to the downside on the benchmark right now. Volumes are still on the lighter side. A lot of markets are still shut. That being said, we have a couple of markets coming online. Bloomberg Markets Asia is just ahead.